Hi, everyone. I'm Sarah Samuels, partner and head of investment manager selection at NEPC. I'm joined by 5 colleagues today who oversee manager selection across asset classes. We have Will Ford, partner and head of marketable equities. We have Josh Beers, partner and head of private equity. Oliver Fadley, partner and head of private debt. Dilari Pancholi, partner and head of marketable credit and diversifying strategies. And Matt Ritter, partner and head of real assets. So we've seen a shift in the market over the last 2 to 3 years. We've seen a flattening efficient frontier. We've seen cash and fixed income actually yielding again for the first time in a long time. We've seen extremely narrow market leadership across both public equities and private equities. We've seen deal activity slumping in private equity, venture capital, and real estate, and we've seen an impasse between buyers and sellers. And then finally, we've seen liquidity challenges for both LPs and GPs alike, leading to lots of creative liquidity tools like continuation vehicles, NAV loans, PICs, dividend recaps, and more. So we're going to talk about all of these themes today, as well as our views on the market and how to implement your portfolio in 2025 and beyond. We'll start with Will Ford, head of marketable equities. So Will, NEPC's asset allocation team is forecasting one of the lowest expected returns from a beta perspective for US large cap equities in history. How does this affect most client portfolios?
Yeah, so look, while forward-looking returns are lower than in the past, equities still really remain the largest allocation to client portfolios, and also the largest contribution to return to risk. Equity allocations still really make or break an investment program, so it's really important for us to get it right. Our recommendation to clients to help with potentially lower beta returns moving forward has been to pivot away from asset classes that are less alpha rich and pivot to those that are. Areas like US small cap, where the alpha opportunity is far more robust. Historically, on a rolling 3-year basis, the median manager within the US small cap space has outperformed the Russell 2000 by over 60 basis points. That's net of fees. In addition, with about 35% of the index consisting of unprofitable companies, it likely amplifies the dispersion of outcomes within the asset class, providing a really strong opportunity set for active management. Other alpha-rich areas include global equity. Active managers in the space have the broadest opportunity set to win and find strong companies that are more global in nature now than they've ever have been. And it also outsources the US versus non-US decision for allocators, which we think is a positive. And lastly, the persistently high dispersion of returns across countries within the global markets really further supports our case for active management there.
Thanks, Will. It's very helpful to paint the picture for the alpha potential in equity programs. So what are some of the themes that are your building blocks for managing equity programs going forward?
We have 4 really exciting themes this year to help clients position their equity programs. And the first theme is navigating a narrow market. This has become one of the biggest challenges for investors to navigate. We continue to push clients to consider the trade-off between index concentration risk, where you have nearly a third of the S&P 500 in just 7 names, and active risk in a very efficient asset class. We would reiterate our preferred implementation approach of leveraging systematic or extension strategies if you're going to be active in the space. Our second theme is around US small caps remaining alpha rich. The data would suggest that there's persistent alpha generated by even the median small cap manager, and we believe that's going to continue moving forward. But on top of that, active managers can find quality amongst really challenged group of small companies that have been disproportionately beaten up by increasing interest costs and debt. Small caps also don't have the same index concentration risk as large caps, with just the top 10 names making up less than 5% of the index. Our third theme is around global equity implementation. Active management across the global equity space has been mixed more recently, but our research supports the belief that as market breadth increases, active global equity managers should outperform. If we see any persistent retreat from the Magnificent Seven leading global equity markets, we believe the world global equity managers will benefit from that. And more philosophically, we believe the world has never really been more global in nature than it is now. And while there are stocks that might be categorized as a US stock, the reality is that having a manager who researches names globally allows them to have a better perspective on both domestic and international names. And then lastly, our fourth theme is a playbook for the emerging markets. While risk persists there, we believe it remains too large for investors to ignore. Just given the volatility associated with the emerging markets, selecting the right type of active management is really, really important. Understand the performance profile of fundamental versus quantitative approaches, and then also consider complementing your allocation with emerging market small cap to provide a better risk return profile.
Thanks very much, Will. I'd like to turn it over to you, Josh, head of private equity. I see some common themes between public equities and private equity, which makes sense because the two are inextricably linked. But a couple common themes that come to mind are the narrow market leadership and small caps being a favored alpha driver. So can you comment on each of those two themes within private equity?
Yeah, sure. Thank you, Sarah. And as you mentioned, just the narrow market leadership, very much like so on the public equity side. On the private equity side, we have our own Mag 7, and that is made up, it consists of about 24% of the overall market. And what makes up that 7 is SpaceX, OpenAI, Stripes, Databricks, Fanatics, Scale AI, and Rippling. And then also, much like on the public side, investors tend to favor the lower middle market, and in particular, the lower middle market buyout strategies. Valuations there tend to be more favorable. They're more insulated to tax, interest rate, and trade regimes, and there's more exit opportunities later on.
Josh, one thing we're hearing GPs tell us is that this is an excellent time for LPs to commit to private equity, while LPs, clients, are cutting back their commitments because of the lack of distributions they're receiving. So can you talk a little bit about fundraising in 2024 and 2025? Talk about deal activity, i.e. lack of distributions, and then talk about how liquidity solutions play into this dynamic.
Yeah. And so first, I'm going to start off with secondaries. And one of the things that we've seen happen within our own client base is an increase expectation with LPs pricing their portfolios. This is a growing curiosity. Most people aren't transacting at this point, but they are pricing their portfolios for rebalancing purposes. Overall, we remain pretty positive on secondaries. We like specialized secondaries, like those that focus on the venture capital market. And then we also like large generalist strategies for portfolio construction, not necessarily performance enhancing. And we believe that continuation vehicles will continue to be a tool that GPs use to create liquidity in the overall ecosystem. And we expect that to continue into 2025. And so some of the causes for the lack of liquidity that we're seeing in the market, we've more or less seen an IPO window for the last 2 years be closed. We're also seeing that buyers and sellers, both in venture and buyout, not meeting on price. And we believe that, going into 2025, that could open up. We're starting to see some bright spots.
Thank you, Josh. These are really great points. And I'll just share a few important points about how NEPC approaches liquidity management for our clients. I'll paint the picture first. While LPs and clients aren't in dire straits from a liquidity perspective, they are decreasing their commitments to private markets relative to 2023 by about 20% year over year on average, about a 20% decline. Why is this happening? When distributions don't come back to LPs, private market NAVs remain elevated, and in a closed loop system, fewer dollars are required to maintain one's target private market allocation. So the commitment pacing plan tells clients to commit fewer dollars when we're not getting it back. At NEPC, we really try to remind our clients to commit to each vintage year, so don't try to time vintage years. but we do apply a really rigorous liquidity guardrail framework to measure each client's liquidity position. And this contains simple but powerful metrics in a traffic light system format regarding the pace of commitments and the uncalled capital commitments, which are essentially a fixed liability for an investment program. And this liquidity guardrail tool that we've built provides fiduciaries with context and information so that they can ground their decisions around commitments and illiquidity. And I think if these liquidity guardrails were in place prior to the global financial crisis, a lot of heartburn would have been avoided. So turning back to you, Josh, what is your outlook for commitments going forward in fundraising?
Yeah, so we're anticipating a very busy year next year for venture fundraising. As many groups originally were planning to come back this year, they've kicked those fundraisings to next year just because of the low transaction volume that we discussed earlier. However, success will largely depend on whether the market's opened for those transactions to actually occur. We're expecting distributions to remain slow across the board. While there are many IPOs lining up, we feel like there's only a fraction of them that are likely viable at this point. And in the lower middle market buyout space, the sector continues to attract interest from larger buyout groups with expansive platforms and strategic investors. Overall, we anticipate the activity in 2025 to be below those peaks of 2021.
Thanks, Josh. And let's just close out with where you see the most opportunity going forward.
Yeah, and I think what you've heard from me is we're going to have a continue focus on the lower middle market and middle market. We believe early stage venture continues to be a great place to invest, in particular in the seed space. Late stage venture is becoming interesting, but we still need to see pricing get better there before it becomes really attractive. And then we're going to be really focused on co-investing as well.
Excellent. So let's shift gears to you, Oliver, as head of private credit. As we think about private equity sponsors and their approach to borrowing, we naturally turn to your team. But the overall private debt market continues to grow in other areas as well, including an expansion away from that traditional direct lending market, which is taking up increasing market share. But can you highlight some of those other areas outside of direct lending that have come to the forefront over the last year that you're most excited about and that you expect to grow in 2025?
Yeah, absolutely. I would start with the direct lending market that, 74% of the capital that was raised last year was to direct lending funds. So it's still a big part of and the biggest part of the private debt market. But we are, expressing caution in terms of partnering with the right GPs and staying, to Josh's point, we feel that there's a better risk-adjusted return with better protections as well in the middle market and less, kind of at the larger end. But as it relates to the areas where private debt has expanded, we do have 4 themes. One is around transitional capital. So as rates continue to be elevated, there's now a split between the haves and have-nots. And so while higher quality companies should be able to find cheaper capital, there are a lot of companies that have not grown in their capital structures, and they are facing liquidity challenge and may have difficulty accessing traditional financing. These deals are more customized form of financing, allowing managers to be a little bit more highly structured in their deals with more built-in optionality than you've seen in the past. And so what you're seeing is higher overall premiums driven primarily by complexity and may include upside participation and 2, better protections with more control, especially around exits. The second area that's come on in a really big way is asset-based lending. So banks continue to get out of this space, and it's a good way to diversify your overall corporate credit exposure as well. So as we were saying, due to regulatory pressures, you're really seeing a pullback from several markets, in particular the asset-based lending space, especially in the smaller, more regional commercial banks. These investment types include, but not limited to, single asset loan originations, whole loan portfolios, securitizations, non-performing loans, structured receivables, and partnering with non-bank originators. The second one that Josh also alluded to is around the portfolio financing or liquidity solutions. There's been an increase in strategies designed to address the lack of realizations across private markets. LPs are in search of more capital solutions for portfolio management reasons. Think of liquidity, rebalancing, maybe some strategic goals. There's a change in mandate, maybe relieve some administrative burden. But you're also seeing GPs seeking financing for fund and asset level purposes, maybe to extend duration or maximize value, crystallize performance, or change in strategic goals. We're seeing a big uptick in credit secondaries and GPLP structured solutions, and to a lesser extent, NAV lending. But we expect all these to pick up due to forced selling as LPs and GPs struggle with distributions. And then the last thing that I would hit on is really the rise of SMAs and crossover funds, or what we call hybrid investments and evergreen funds, which we're seeing both on the private credit side as well as Dulari's credit hedge fund team.
Well, this is a great time to shift to you, Dulari. As head of marketable credit and diversifying strategies, where do you see the most opportunities within marketable credit today?
Sure. And I'll walk everybody through the liquidity spectrum because that's the wide coverage that my team has. So starting with high grade, as many of you know, the fundamentals as well as technicals in the high grade market had continued to improve across 2024. And that has resulted in significant spread grinding tighter and tighter. So overall on the high grade side, the opportunity has definitely tempered a little bit. But even so, it continues to be a great source of liquidity for the portfolio and still continues to provide a strong yield support. If we think about where is the opportunity in that space, one area that we still like is agency mortgage-backed securities. The spreads are still wide there, and we've seen allocations ramp up a little bit on that side. And if M&A picks up in 2025, we should definitely see some dispersion in the investment grade side as well. And shifting gears a little bit on the return-seeking side, I'll highlight three main opportunities. One, if clients cannot tolerate illiquidity, then looking at some long-only multi-sector funds that can tactically shift allocations between loans and bonds is a great place to get some return in the fixed income space. The second is if you can withstand a little bit of illiquidity and complexity, then looking at hedge fund credit strategies, especially ones that are like more geared towards structured credit space, especially within that targeting CLOs, CMBS. And then we also like the event-driven strategies that are focused specifically on distressed corporate credit. There's still, some tactical trading opportunities left in that space. And last but not the least, if you can withstand even further more illiquidity in the space, then as Oliver mentioned, we're seeing a significant rise in hybrid type of products. We call them hybrid because their attributes span between hedge fund credit and private credit space. So from a liquidity standpoint, they're sub 5 to 7 year terms. They target anywhere from 13 to 15% IRR, and their focus is mostly on more nichier type of credit space, like structured credit or leaning into some distressed stress areas. So based on your liquidity and complexity preference, you can choose whichever strategy that best fits your portfolio.
And so you also oversee a diversifying strategies team. So we know that credit and rates can be diversifying to an equity-centric portfolio, but you also run other strategies like global macro and relative value and multi-strategy hedge funds. And your team just released a comprehensive white paper on the topic of diversified strategy investing. So what should clients think about in 2025 and beyond?
Right. And a big shout out to my team. They've spent a lot of time putting together a solid white paper talking about how to build diversifying allocations, what are the considerations, and more importantly, why to think about these in a more strategic framework for your portfolio. So what are these? These are basically hedge fund strategies like global macro, multi-strategy, fund of funds. And the goal of building these allocations is just to enhance and improve your long-term risk-adjusted return for the total portfolio. And I will underline the risk-adjusted part because I think everything that we've heard so far is more geared towards return building side of the portfolio. And this allocation is specifically geared to create a long-term sustainable risk-adjusted return. And the main reason we think about this is because in most cases in upward trending markets we tend to forget these allocations and these strategies. But when markets are shifting gears and there is uncertainty, that's when you really need these. And unfortunately, if you start building an allocation at that point in time, markets have already the valuations already reflect every concern in the market, and it's a challenging time to rebalance from anywhere else into these strategies. So having a strategic allocation is recommended. And I would encourage everybody to, if you've not already read our white paper, please do so. It goes in really deep specifics about how to think about this space, and also not in context of just long only, long short, your stock bond portfolio, but also in context of some of the considerations of private markets that my colleagues just spoke about.
Thank you, Dilari. Matt Ritter, we'll turn it to you. As head of real assets, love to hear your thoughts. We do see some common themes for sure that extend across all of these asset classes we're discussing today, like the cost of capital, the lack of liquidity, and limited transactions. But the most striking to me is opportunities that exist in the secondary market. So tell us a little bit about where you see opportunity there in private real assets.
Yeah, for sure. We definitely continue to see a lot of good opportunities in secondaries across real estate and real assets, though I would say that there's sort of different market drivers in those different segments. So the infrastructure market, on the one hand, is seeing considerable growth in terms of capital raised and just the overall maturity of that market. And as infrastructure has grown in investor portfolios, so too has the need for some of these tools like LP-led secondaries. In fact, we've seen transaction volumes for infrastructure secondaries increasing on average about 15% per year. So really strong growth in terms of transaction volumes there. The real estate market, meanwhile, is in a much different place, and it's still facing some capital market headwinds. So I think within real estate, we view secondaries as one of a few different strategies where you can position yourself as a capital provider and a solutions provider to a market that still has limited liquidity. In particular, we've seen GP-led transactions grow dramatically in recent years on the real estate side. And in a similar vein, we see a lot of legacy energy private equity funds reaching the end of their fund life and facing limited liquidity as well. So, that in turn has led to things like fund extensions, continuation vehicles, things like that, both of which are driving the need for secondary capital.
Thank you, Matt. So what are some of the themes? You touched upon a few of them, some themes in both fundraising and where you see opportunity. And the two of those may not be the same thing.
Yeah, so there's a little bit of overlap there. I mean, I would say, in terms of fundraising on the real estate market, fundraising's been down for the last several years. And I think we expect that to start to rebound in 2025. I don't think we're going to hit a new high or anything in terms of fundraise volumes, but I do expect to see that start to look a little more positive. As far as opportunities in the real estate market, we are seeing some signs that pricing or values may have bottomed. Transaction volumes are starting to rebound. They are still pretty low, but again, some positive signs at least. So liquidity is still somewhat limited. And as I mentioned, we like secondaries. I think other ways that you can position yourself as a liquidity provider to this market is through things like real estate lending, as well as some opportunistic equity strategies. There's also a few specific property types that we're focused on, including attainable housing, industrial, and data centers. I would say in terms of infrastructure, shifting gears to the real asset side, fundraising themes, I mean, we're continuing to see growth in the infrastructure market as far as fundraising goes. I would say a trend within that is you're starting to see some newer firms being launched, spin outs or departures from larger firms, maybe managers that are targeting a specific niche or segment within infrastructure. And I think that is in line with one of the themes that we're seeing in infrastructure, which is kind of this focus on the lower middle market. So as some of the older infrastructure investment firms have gotten quite large, you're seeing this opportunity to kind of splinter off and focus on the smaller end of the segment. We're also continuing to see attractive opportunities in themes like digital infrastructure and power and energy transition markets. And then I think the last area I would focus on is the traditional energy sector. So, upstream oil and gas. That is a market that has been, really challenged in terms of fundraising the last several years. We're starting to see some increase in capital raised there as well, but the number of funds is still quite low. So, I think what that tells you is it's kind of survival of the fittest and some consolidation happening in that space. We do think that is an attractive area to be investing in, but we're a little bit cautious, focused on those experienced managers and those that have a pretty strong emphasis on protecting on the downside. And then, of course, lastly, as I've touched on, we also continue to like secondaries as far as opportunities across real estate and real assets.
Thank you so much, everyone, for sitting down with our audience today. This is a really important year, and we need to remember that all strategies and all investment managers are not created equal. Manager selection matters more today than ever, given the uncertainty on the horizon, which is where NEPC's investment experts can help you get it right. We talked about a number of themes today that really permeate every area. One is that it's a wonderful time to be a provider of liquidity, whether that's as a lender or through a secondary transaction. And that liquidity management matters a lot today. We have our proprietary liquidity guardrail framework for our clients. If you'd like to learn any more about NEPC or the investment topics we talked about today, we would love to hear from you. Thank you.